Joel Greenblatt's hedge fund realized an average return of greater than 50% per year over its 10-year life. He and his partner closed it down when they felt they were getting too large. They believe, and maybe you could say they have proven, that the small investor has an advantage in the world of investing. The top 5 lessons new investors can learn from Greenblatt's wisdom coming up. I just love studying the legends of the investment world. You can learn so much, and I'm glad that today we get to do it together, because the lessons I'm about to share with you are going to put you at least one step closer to building your rapidly growing, highly diversified net worth. As I go through them, if you find these lessons and tips helpful, don't forget to subscribe and click that notification bell, because there is so much more to learn to help you become even more successful. Joel Greenblatt is a value investor, meaning he actively looks for stocks that he believes are undervalued by the market. He's written 4 books that are each packed with so much experience and insight. It was his first book, You Can Be a Stock Market Genius, that really set me on the path that I'm on today for how I find undervalued stocks. If you're interested in any of these books, any of his books, I've linked to all of them in the description below. Let's get started. Lesson 1, have a strategy. Do some research about how you want to invest and specifically what you want to look for as you conduct your stock research. Do this before you even start analyzing individual stocks. That can be hard for the impatient, but investing in individual stocks can be dangerous if you don't have a strategy. You don't have a plan. You don't know what you're looking for. Greenblatt says, and I love this, choosing individual stocks without any idea of what you're looking for is like running through a dynamite factory with a burning match. You may live, but you're still an idiot. You might get lucky trying to trade stocks without a specific strategy, but that doesn't make it any less dangerous. When you aren't sure what you're doing, when you don't have a plan, you're more likely to make mistakes. You're more likely to blow up your portfolio. Lesson 2, focus on the downside. It seems like most people try to focus on the upside. How much could this go up compared to where it is today? That is important, absolutely. But you'll likely fare better over the long run if limiting your downside risk carries more weight in your ultimate decision. That means focusing on companies that have a large margin of safety. Margin of safety refers to the difference between the value the market is placing on a particular stock and your estimation of its intrinsic or fair value. That way, even if your calculations and estimations are wrong, you could still make money, or at least it's less likely that you'll lose as much. He says, look down when making your initial investment decision. If you don't lose money, most of the remaining alternatives are good ones. Lesson 3, invest for the long run. Individual stocks, entire markets for that matter, move all over the place when you're looking over short time periods. Every second, every hour, every day, every month, even every several months. There are so many factors contributing to each and every move. But think about this. Just because a particular stock's price shoots up 1 minute and then a few minutes later shoots back down, which happens a lot, did the underlying company's value, like what it's actually worth, what someone could reasonably pay for the entire company, did it change very much over those few minutes? Usually, no. Greenblatt says, although over the short term, Mr. Market may price stocks based on emotion, over the long term, Mr. Market prices stocks based on their value. So do your research, run your analyses, and invest for the long run based on value and ignoring emotion. Lesson 4, know what you're doing. I created an entire video on the extreme importance of knowing what you're doing and why, of not just blindly relying on someone else's, some expert's hot tip. At the beginning of You Can Be a Stock Market Genius, Greenblatt lists a few investing basics. He says, 1, do your own work. 2, don't trust anyone over 30. And 3, don't trust anyone 30 or under. even more than his delivery, I love this advice. That's why in that video I just referenced, I tell you sincerely that you should even supplement what I say with your own research. It's part of the reason I encourage people who disagree with me to do so in the comments, because healthy discourse can help all of us, me and you. Actually, that reminds me of another great lesson from Greenblatt. I'll throw it in as a bonus lesson after we get through number 5, so stay tuned. But this point of knowing what you're doing is also why I created my Patreon page, as a way to disclose everything. My research, my observations, my own trades. So you don't just have to take what I say at face value, so that you can see behind the scenes. You can have everything you might want and need from me to supplement your own research and analysis. Lesson 5, stay the course. This is part of the reason why lesson 1, having a strategy, is so important. If you don't really understand what you're doing, what your strategy actually is, you'll likely bail at the first sign that things aren't going perfectly in your favor. Value investing in individual stocks is a longer-term trading strategy. That means sometimes the companies you've identified as being undervalued don't realize their fair value for a year or 2 or 3. As an extreme example, that happened for a long time to a lot of stocks during the dot-com bubble, when most investors didn't care about anything that didn't have to do with the internet. Nobody was paying attention to anything. That didn't mean that those stocks didn't have any value. It just meant that the market was not yet paying enough attention to them to realize that value, which is kind of what you're waiting for if you're a value investor. If you've done the research, you've conducted a proper analysis, you know what you're waiting for, then in those cases, you should stay the course. And the more you know, this is so important, the more you know and understand, the easier and less stressful that waiting process can be. Greenblatt points out that when faced with 2 or 3 years like that of underperformance, most people are not capable of sticking it out. But remember, it's because it's difficult that it continues to work and provides us, you and me, with opportunities to outperform everyone else. Now here's that bonus lesson from Greenblatt that I promised. Welcome challenges. Greenblatt says there's a virtuous cycle in people having to defend challenges to their ideas. Any gaps in thinking or analysis become clear pretty quickly when smart people ask good, logical questions. It's critical that you understand why the market isn't seeing the value you do. The back and forth that goes on in the investment process helps you get at that. Most people try to avoid confrontation. But challenges to your investment ideas, although they may temporarily damage your pride, can protect the bottom line of your portfolio. Which is more important to you? If it's pride, maybe you shouldn't be investing. Those challenges can help you see things from a different perspective. I can think of a few times in the past when writing for Seeking Alpha even, that commenters presented me with material information that I hadn't found on my own, that weakened or sometimes strengthened my investment idea. I'm always grateful for that. It makes me and my readers, and now my viewers, better traders. So there you have it, the wisdom of the legendary Joel Greenblatt. Have a strategy, focus on the downside, invest for the long run, know what you're doing, stay the course, and welcome challenges. I'd love to hear from you. What are you going to do with this? Which lesson will you learn from today? What action will you take to change the way you approach your investment strategy? I can't wait to interact with you in the comments. And if you're new here, congratulations on starting your journey to a rapidly growing, highly diversified net worth. If you want to continue learning, then don't forget to subscribe and hit that bell so that you don't miss any of these timeless lessons. Hit that like button if you liked it, share it, and most importantly, don't stop learning. I'll see you in the next video. Take care.